Today, it's actually a very funny title. We don't always need candles at night, right? And okay, this is 1 more minute. It will be live. You don't only need candles at night, basically. That's the title of today's stream. And I'm going to highlight 2 points: candles and night. So these are talking about candles and certain time, a time of the day, which is night. So basically, this was just some form of curiosity spike, clickbait thing. But what I'm trying to talk about is time frames, candlesticks and time frames. And this is actually very, 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 very important. Track the market and make profits as you do so. All right. So I'll be talking about time frames and candlesticks for the next 1 hour. And obviously I cover this topic in my course. But just because it's very, very important. I know everybody must have seen the course, so I'm just going to do that here for a quick, I'll just do a quick recap for 1 hour. All right. So, what's a candlestick? Candlesticks are what you see on the charts. Sorry, let me adjust my camera. Okay, do this. So when you look at the chart, what you see, these things you see on the chart, they're called candlesticks, right? And they actually look like candles. I mean, let me zoom out for you to see. They look like candles. So they have this. I should have a picture of a candle somewhere. I think I do. Let me add a picture for you, so it's easy to understand, right? So you get a point of what I'm trying to say. Image. I downloaded some. I don't know if I still have them. Okay, so I have one here. Okay, no, that's not it. I have this and this. Okay, so I'll go with this first. Okay. So two pictures, this and that, and oh, I think I'm too far behind now. And this. All right. So we have these two pictures, and this is what I'll be explaining with. Right, this is a candle, right? And when you look at this candle, what you find is a big waxy part, which is this part. This is what we call the body. And when you look at the candle that has not been lit, the candle that is still new, you don't see much of the wicks, right? You just see white wax or colored wax, whatever it is, and you see a short wick at the top. That's where you put the flame, right? And then when you put the flame, so let's imagine you cut off that wick. You just have a whole body, a whole, candle, right? And then when you have that candle, it seems like there's no wick inside until you light the flame, and then the candle starts melting. Then you start seeing the wick. Okay, so that's how the candles on the market are. So when you look at the chart, you see a candle like this, for instance. Let me show you this. A candle like this, for instance. All you can see is a whole wick, a whole body. So this is like the candle that has not been lit. Except let's just ignore this small wick at the bottom. This is a candle that's not been lit. But when you look at some other candles like this, something like this, for instance, this one, you can see a really, really small body and a really long wick. This one. So what does this all mean? What is a candle generally? And we cannot understand candle if we don't talk about time frames. All right. So a time frame is basically a fraction of time, right? It's like, as the name implies, time frame. So it's time being framed within a specific. It's just basically a block of time. So let's say in the day we have 24 hours, right? So when you go to the hourly time frame, if you click on this, if you look up here, you're going to see different times: 1 minute, 3 minutes, 5 minutes, 15 minutes, 30 minutes, 1 hour, 2 hours, all the way to 12 months, right? So right now I'm on the 1 hour 1 hour time frame. And what that means is each candle here took 1 minute. Sorry, it took 1 hour to complete. And all this while we've been talking about price action and how price moves in the market. And basically what we are seeing is price movement, price action. Okay. But when you come to the 1 hour time frame, what this tells you is this each candle you see here represents 1 hour worth of price action. So it was basically price action captured within an hour for each candlestick you see here. Okay. But if you go to somewhere like the 4 hours, it's now 4 hour worth of price action captured within one candle. And what does this candle tell us? They just tell us the story. They basically tell us what price has done within that time frame. So you see how these two are correlated and how it helps us understand what's going on in the market. And we put all of these things together, right? Because you can't just trade the market without understanding what time frames are. Okay? But before I do that, let me quickly share a link of this a link for this stream to my people. Okay, so I'm coming here. And I'm just gonna share this. I hope you guys had a nice night's rest. And today's actually going to teach you something new, right? Something new, something new. I can't even find. What is this now? Okay. Oh, I already have. Okay, so I'm just gonna see if I can leave a link to. Let me see if I can leave a link to this here. What do I do now? Save. Let me just confirm that on my phone. Okay, so I'll do that here as well. Here. And I'll just open this. Oh, this one has to go now. This ain't got no design. Delete this. Okay, so I think this works. What next? I'm just gonna make a quick post to status chart. Okay, so let me do this now. I'm just gonna do this on each videos. Okay. Click on this and A4. Six. Timeframes, right? Just gonna save this now. And all right, so we're back. Okay, so what I was saying was time frames and candlesticks are always correlated, right? So every candlestick tells you about, like, gives you information on what price did within that time frame, right? So I'm just going to, what am I trying to say in essence? So so basically I just described the candle, and the candle is divided into two basic parts. We have the body, which is this part, and then the wick, which holds the flame, right? But actually, when you look at the candles in the market, this is what they look like. This is what they look like. So imagine you burn this, light the flame at the bottom of the candle. It's still going to expose some wick at the bottom, okay? And I think I can, do something. Um, let me quickly create a something that helps you conceptualize this idea. I'm just going to go over to Paint and save a picture of what it is we're talking about. Okay, you know what? I have a video on candlesticks in my Minimalist Forex course playlist, right? So I basically use the same pictures and explain the same concepts. So to do you real good to actually watch that video. It's quite short and it's going to just quickly explain what this whole thing is. But basically, if you look at this candle, the flame was lit at the top. That's why you saw the wicks at the top, right? But if you had lit the flame at the bottom, the flame would have exposed wicks at the bottom. So this is basically what is happening here. You have the candle body, right, which obviously is the big part of the candle, and then you have the wicks at the top and at the bottom. And what this just tells you is that there was, if you see a wick at the top, it just means there was selling pressure from the top because sellers push price down. So it pushes the body of the candle down as it melts. Okay. And if you see wicks at the bottom, it just tells you that there was bullish pressure from the bottom, right? That's why it's exposing, the wicks from the bottom. All right. So basically, this gives you an idea of what price did. Okay. But now the candles are different for both bearish and bullish candles. So for a bullish candle, like we know, a bullish candle is a candle that starts at a point and goes upward, because bullish just means going upward. So it starts at a point, opens at a point, and then goes upwards and closes above where it started. Right? So we have the open of the candle at the bottom and the close of the candle at the bottom. While for the bearish, it's coming downward, so it has to open at the top and close at the bottom. So we have the open at the top, close at the bottom, and you see it's flipped. While the bullish candle opens at the bottom, the bearish candle opens at the top, right? And then we also have the high and the low. And this basically is just the highest point the candle got to and the lowest point the candle got to. Let me quickly show you what this looks like on the charts. I'm just going to delete this because I don't need it anymore. Okay, so this candle was a bullish candle, right? So the candle opened here, opened at this bottom. Let me use the candle opened here, okay? Came down to this wick, to this lowest point. It opened here, came down to this lowest point, and then went all the way to this highest point, but came down to close here. So that's why you have, the bullish candle. So it's actually, if price opens at a certain point, what makes it a bullish or a bearish candle depends on where it closed. If it closed above the open, it's going to be a bullish candle. If it closes below the open, it's going to be a bearish candle. Just hope that makes sense. All right. So that's that for bullish candles. While for bearish candles, let me use a typical bearish candle like this one. Price opened here and came down to close here. But before it closed there, it came down to this low. So it created this low. So when price came to this low, there was now buying pressure from the bottom that now pushed price and made sure price closed here. Okay, so this just tells you there was some sellers here, and as you can see, it's happening at the bottom of the market. Because if you look at this point, like we said, we have, from our knowledge of market structure, we have a high, a low. At the bottom of this point, which is this low, you can see the weak bullish pressure pushed price upward. Price went on to break structure. So when price breaks structure, what does it do? It pulls back. When it pulls back, it's coming to a point where it has to start going up again, and you start seeing all the bullish pressure from the bottom. Why is there so much bullish pressure? Because it took institutional volume, like big money being infused into the market, to push price from this bottom, to break this level, right? So it took a lot of money to break this level. So when price is coming back down here, the same people, they have invested interest because they have a lot of money here. They're still going to push price up from here. Do you get? So you tend to see a lot of wicks at the bottom of the candles when you're at a low in the market. Okay. And that's just telling you that price is coming downward to find support. And I don't think I've talked about support on this live stream. But basically what a support level is a level where price jumps on, price jumps on support, springs on it, goes upward, come down, jumps on support, goes upward. So that's just what happens. Support, you always find support at the bottom, whereas at the top, you find resistance. So the market was finding resistance here. That's why it came down. It went up, found resistance here. That's why it came down to support. So the same way price bounces between supply and demand is the same way it bounces between support and resistance. Now, I'm going to use this analogy. You have a house with, if, okay, no, let me just come this way. All right. So when you have a house, let's say you have a story building. Okay. So basically, it's a house with 3 floors. How do I do this? Oh. It's a house with 3 floors. You have the first floor here. You have the second floor, right? And then you have the third floor. Oh, you have the third floor up here. Okay. And then you have your roof. So let's say it's a flat roofed house. All those fancy houses, flat roof. And then you have 3 floors. And then you have somebody, an occupant in the house, which is going to be this, and his name is going to be Price. So this is Price, Mr. Price, staying inside this house. He's standing on the floor of the middle. He's in the middle floor, but now below him is a level that supports his weight, right? So that's what we call, that's why it's called support, because it supports his weight. So no matter how excited Price gets, he's always going to bounce off this support level, right? But then at the top of above him is the ceiling, and that ceiling is always going to prevent him from going out going, breaking into the floor above. And this is going to be his resistance, right? So no matter how excited he gets, no matter how high he jumps, no matter how strong he is, he's always going to be bouncing between these 2 points, right? And in the market, if you look at this, you're going to always find that this point coincides with, some kind of supply, whereas this coincides with some form of demand, right? Because price is always going to be moving between supply and demand and support and resistance. However, there could be a point along this floor that is not strong enough to hold price, and maybe price is now so excited, or for whatever reason, price has to come down. That's when price now breaks below and comes down. And then when it comes down, it's going to find what? Another support at the bottom, because it's now at the base of the house. So it's definitely going to find support, right? And then the previous point that was one support, which was this area, now becomes his resistance. And everybody knows this. If you go from the middle floor of your house to the bottom of your house, the floor above, the floor that was, what was the floor at the middle floor now becomes the ceiling at the, bottom floor. And it's the same thing when you go upstairs. So when you go upstairs, so from this point now it has a resistance. If he breaks above that resistance is going to become his support. He now has another resistance on top of him. If he breaks above this resistance now becomes support. So that's how price keeps moving between support and resistance. And his ability to come down, whether or not he'll be able to come down, depends on what he's going to use a staircase, right? That staircase is the trend. So whenever price is coming down, we say it's trending downward. Okay. So he looks for a weak area where he has a staircase and then it starts trending downward. This analogy works really, really fine because it just breaks it down to what you know. All right. So if price wants to go into the floor above, it still has to trend upward. Okay. No matter how many times it has been stuck within this range, it's going to find a means to go upward or come downward. Right. And that's the staircase. So I'm just going to clear all of this out. I think I just quickly talked about support and resistance. I'm going to show you what it looks like in the market. I'm going to show you what it looks like in the market. take this out. Okay, so let's look at quick support and resistance. The base of the candle, the base of the base of the chart at this point, this was support because why? What price came down, bounced off it, and shot up. When it shot up, it came to another level, which was the resistance. Okay, resistance broke below resistance, trended downward using the staircase, and came to a new support. Right, and so perfect case. Look at this. This was a support. This was a support. Price went up, created the resistance, came down, created another support here. Okay, created another support here. And mind you, support is not just a line, it's a zone. I mean, there are no lines in reality. They are just, zones. There's no perfect line. Everything that's perfect, everything that is a perfect line is man-made. Like the tables you use, tables are made from wood, but the woods are not perfectly straight, right? It's humans that made them straight. The walls of our houses, the bricks with which we make our houses from, they are all straight and they're all man-made. So in nature, nothing like there's no straight thing exists in nature. I mean, point out something that's straight. I don't think you can find any that's perfectly straight, as in 90 degrees angle. You can't find it. So in the market, it's not a single line, it's a zone. So this is our zone. Support here came up, broke below it, went all the way up, came, bounced off it, went up, broke below it. And as you can see, as it broke below it, it came up, used it as a resistance. It couldn't go any higher, it came down. Went up, couldn't go any higher, it came down before it eventually broke. And when it broke, it used it as support again, played around it, came down. So it's just like price was unsure. It was just going up and down the staircase, and it was not even sure if it needed to go up or if it needed to come down. Price broke above it, used this point as support, went above it, found a new resistance, came down to the previous support, bounced above it for a while, then went up again. So you can see whenever you find a support and resistance, like whenever you just see an area that price struggled, that's basically support. And at the time it supports, but in the future it could be resistance. So price is always turning from resistance to support to resistance to support using the same levels. Okay. So I was talking about time frames and candlesticks. So this is the 4 hour. Every candle here represents 4 hours of price action. Okay. 4 hours of price action. And when you look at the candle, the base of the candle, at every support, you find the wick. And that's basically bearish, bullish volume, bullish momentum. So buyers are stepping in to push price upward. So you find the wick. So if you just take a random point in the market, just any random point, at the top, you're always going to find wicks at the top. Right? At its resistance, you're going to find wick at the top because this is price rejecting that area because sellers are stepping in to push price downward. They're like putting flames at the top of the candle to melt, to burn down the candle. And once you see this, a bearish move is starting. And as you can see, price came down. All right. Then when you came to the bottom of this zone, you see price failed to break at first. It struggled. It went up, came down again, broke this level, but it failed to continue. And then it started going up. But at the base of this level, you can see wicks at the bottom. Wicks, wicks, wicks. You can see wicks at the top, but it's just struggles. Like it just tells you they are struggling. They are struggling. But at the base, you're always going to find wicks at the bottom. And all of this comes together to, okay, see for instance, see this area. Price created this low, created this high, right? So this was what? A high. Price then came down to create this low. Okay. So from this point, price went up. And in an attempt to break this level, it couldn't do that at first. It came here and it struggled back down. But when it came down to this point, you can see the big buyer stepped in at this point. So you have this large wick, and then from here it broke the structure. So you're always going to find it at the base of the market. You're going to find it at the base of the market. Even when you're finding them at the middle of maybe midway through the range, they're not always going to hold. I mean, that's why you're combining market structure. You need to know where you are. You need to know if you're pulling back. If you need to know if you're actually shooting above, to break structure and create a new high, or shooting below to break structure to create a new low. So this all comes together. First thing is market structure. Second thing, supply and demand. Okay. Thirdly, you're incorporating your candlesticks, right, to understand what price is doing. Now, the fun thing about candles is that, as the name implies, this time frame, this is the 4 hour time frame. So it means one candle took 4 hours to print. Okay. So if one candle took 4 hours to print, what does that mean if you go to the 1 hour time frame? It means that 4 hour candles contain 4 hourly candles. Right, this is Bitcoin USD. And right now, the current candle is printing because Bitcoin runs throughout the day, throughout the week, throughout the year. Okay. So as you can see, if you look to the left, to this area, you see 35.8 seconds. So this is the time. This is the time it's going to take for crazy. This is the time it's going to take for this candle um to start to close. So it has been running for over 3 hours, 20 something minutes. So it's remaining 30 something minutes to close. But now if you break this candle down, if you go down to the 1 hour, you're going to see that this candle, let me just highlight this. This candle contains 4 hourly candles. Right. So you have 1, 2, 3, 4. Okay. 1, 2, 3, 4. These 4 candles made up. This is what makes up the H4 candle. Okay. So it makes up the H4 candle. So if you go down to the 1 hour, each candle here now takes 1 hour to print. So each candle here contains two 30 minutes candle. So you just break down the time, 60 seconds make 1 minute, 60 minutes make 1 hour. So that's how you just keep building up. So everything that happens in the smaller time frame builds up to the higher time frame. Okay. So that's that. Let me see. I took this Bitcoin. Oh, it didn't even activate. I took a Bitcoin short here, buy here at this week, but it didn't activate for some reason. Don't know. Anyways, okay, so that's that. That's that about this time frames and candlesticks, right? So how is this important? I'm going to now analyze the charts and we're going to incorporate candlesticks into our analysis, right? Just to give you a brief idea of, like give you an overview of what I'm talking about. And secondly, candlesticks are the language of the market. So the same way you have, let's use English language for example. You have like I'm communicating with you with like I've used a lot of sentences. Each sentence is basically broken down into phrases. Okay? Each phrase is broken down into words. Each word is broken down into letters, right? Which are just a bunch of signs that mean something. So that's how the candles are broken down. So when you start from the bottom, you have the candlestick, a single candlestick comes together to form a candlestick pattern, right? And I'm going to talk about that. And then from the candlestick pattern, it moves upward. A series of candlestick patterns forms a chart pattern. Series of chart patterns now like gives you, a whole trend and like gives you an idea of what price is doing. So let me just it's good to see you. Okay, so yeah, so I'm going to quickly talk about candlestick patterns and the I think the number one candlestick pattern, like that's all that matters, is the engulfing pattern. Like every other candlestick pattern you see are variations of the engulfing pattern. So an engulfing pattern, basically the word as the word implies, something that engulfs something else is something that swallows up something else, right? So you have if you're a science student or if you do science, you know there's a certain species of white blood cells that engulfs pathogens. So it swallows up those pathogens, those disease causing organisms, it just swallows it up and destroys it. Just a quick one. But basically, an engulfing pattern is an engulfing candle is a candle that engulfs the previous one. So it swallows the previous one. So let me show you what an engulfing candle looks like. This is one example of an engulfing candle. Zoom in. Okay. So you look at this. This bullish candle swallowed up the previous candle. Okay. So this is an engulfing candle pattern. And what does this mean? It means bulls are stepping in, buyers are stepping in into the market because each of this, the top of this candle represents a high. This is a low. So for this to happen, this means it has broken structure in a much smaller time frame. And it takes a lot of money to do this. So that just means bulls are stepping in. Like there's a lot of bullish momentum or buying momentum that steps into the market to do this. So whenever you see this at the base of the market, you know the buyers have started stepping in. So all you have to do is the same thing you do when you see a break of structure. You wait for a what? Pullback. So you see the pullback, price printed, but it came down here before it started going up. So you wait for a pullback to enter. And at least that pullback is going to happen at least halfway through the candle. Let's measure the height of this candle. From this high to this low. You see, it came halfway, 50%, tapped into it before going upward. Okay. Same thing happens at the top of the candle. You saw this week means there's a lot of rejections. The sellers are stepping in. You now see a candle that engulfs, comes up, engulfs it here. Okay. But in this case now, the retest didn't happen. It didn't go 50% into the candle. It's around even, it did not even make up to 20% of the candle. Okay. But this happens, and this is mostly because it's a bearish market. Like the bearish momentum is still high. So it does not really have to come up to test, that area sometimes. That's how it happens. So now when you see the bullish engulfing candles, I'm showing you two candles where one engulfs the other one, but it actually has different variations. So you have the variations that the candlestick bullish engulfing candlestick pattern does not involve only two candles. It could involve up to three candles, four candles. As in this case, you have three candles here. So you have this candle, right? But this first bullish candle failed to engulf this one, but the second one did, and it engulfed it here. Okay, it engulfed it here. So you're expecting a retracement to this level at least at some point, And let's see if that happened. Because price can't just break structure and then you're buying from wherever price broke structure. Price has to come back into it. Okay. So when you look to the left, let me make this thinner. When you look to the left, this whole zone, of course, if you're taking a buy from wherever within this place, your stop loss is going to be below the overall low. So you see price taps into it at first with this week, and then price went up to this point. So price reacted from it. But just because they had to tap into liquidity, they came down, swept the overall the lows and went up. And I'm just saying this from just this time frame. If you're going to trade the market, you're going to combine a lot of all of this to get context as to what price is doing. All right. So yeah, if you look at this, I can actually see what price did. There's this low, there's this high, there's this low. Price broke this high. So price has to come down to take this low, to get liquidity to go up. So when you mark this low, zoom into this point, you see how price cleared it before price zoomed all the way to the top, right? And whenever price taps into liquidity, it just shoots. It just shoots all the way. All right. So it's the same thing here. When price broke the structure, price has to come back down. Okay. But now it now depends on whether or not price has some form of structure to base liquidity on. But we could randomly just say price is going to take out this low before going up again. Price is going to take out this low, tap into demand somewhere below here before going up. And if you look to the left, you see price is close to it, but price has not tapped it yet. So whatever price is doing right now is because price is trying to seek demand supply to generate enough, force to come down to break below. So I just hope that makes sense. If you've been following my videos or if you've watched the course, you actually have an idea of what I'm talking about. And the link to the course is actually in my playlist. It's actually in this description. So do well to check that out. And yeah. So that's that. I'm also going to show you another example. I'm going to show you. It actually pains me. So it's something like that happened here. Something like that happened here. You can see the candle. See how much bullish volume kicked in once price tapped into liquidity below this low, right? So price did this from this bottom. Price went up, created this high, created this low, created this high, created this low, and broke structure again. So price is going to come back down and react off this because there's a demand zone here. There's a demand zone here. Let me zoom in so you all can see. If I delete this, there's a demand zone. If you look at the candle that has the bullish momentum, this entire zone is a flip zone because this is where price flipped. Like it went bullish, came down bearish, and then flipped all the way to bullish again. So this entire zone is also called a flip zone. And then you're always going to find demand in a flip zone. So you can use this entire area as your entry. You can enter here, take a buy here. But because we want to refine it, we refine it to the candle before the momentum candle. Okay. Right. So ideally, your trade is supposed to look like this. You buy here, you target, your stop loss is going to be below the previous low, right? And then you target a supply, the nearest supply at the top, which is going to be here. This is what an ideal trade looks like. But whether or not you're going to win this trade depends on where your stop loss is. Okay. But now, if you look to the left of this structure, you can see that price did not have any substructure to base liquidity on. So this is what I'm talking about. When you have this, boom, and price shoots up. These are two bullish market scenarios. You also have this. Is it not working? You also have this. Price fails to take out the high, comes down, creates a low, and shoots up. These are two market conditions where price broke structure. Broke structure here. Why does this keep happening? Price broke structure here. Same thing happened. Same thing happened here. Price broke structure here. So in this case, in the first case, you have a demand zone where price started from. Okay. And what you're expecting price to do is from this point, it's supposed to pull back because it was broken structure, tap into this demand, and then shoot up. All right. I'm going to make this blue. Okay. And I'm going to make it bold. All right. In this other case, there's a demand at this bottom, but this demand does not exist at this base because this was not where price shot up from. Price actually came up, failed to break the structure and came back down. So it was at this point you're going to find your demand here. All right. So what you're expecting price to do is come down in, oh shit. Come down into demand before breaking structure. The same market conditions, but they happen differently. Now, when you look at this point, you can see this low being formed. You can see this low. This low was formed. And everybody is going to be like there's no liquidity to the left for the market movers to tap into. Because everybody that takes a trade here, everybody that's going to take this trade is going to be putting stop losses below the low. Right? And that's the stop loss they need. They need those stop losses to actually, get enough liquidity to buy. So they're going to force price down below this low because they know they would basically want to take people out of the market. So your entry, this is what happens. Typically in this condition, this is what happens. And this now shifts what's your. So if you understand, if you know this is what the market does, what you want to do is not take your entry at this top. Actually take your entry at the base here because price is definitely going to come down to it. Right? So while everybody's taking their trades at this top, you wait for price to tap into what's your. I don't know why this is lagging. Okay, you wait for price to tap into liquidity and then you take the trade. You can as well take the trade up here, but make sure your stop loss is not too tight. But this is the safest place to take your trade, right? And then you're going to have a much higher risk to reward ratio. So you're going to be making more money. Now, in this case, where the market did this, sometimes market can just tap into demand here once and go. Even in this case, sometimes market can just tap into demand here and just go. That's why you can still take the trade here, but your stop loss shouldn't be so tight because there's a chance they are going to need to sweep liquidity at this bottom, right? So this is what you're looking out for. Understand market structure, know where you are in structure, know if you're pulling back. And when you're pulling back, look for a supply and demand and watch. Has price taken liquidity yet? If it has not, make sure you watch out for liquidity. But if it has, then you can just, trade from wherever. All right. So In this case, you have same thing. You have, why is this? Okay, in a smaller time frame. Let me go to the 30 minutes. Okay, so in this case, same thing is going to happen. Same thing is going to happen here. The market failed to break this high. So what is it going to do? This was the low. This was the high. The market broke this high, but it didn't break the high from this low. It actually broke it from this low. So what the market is going to do is people are going to be buying here, targeting this high, right? Stop loss below this low. That's the crazy thing. That's what most people do, below this low. But what you want to do is because you know the price has not swept liquidity yet, you don't want to. There's a saying that if you don't see the liquidity, you automatically become the liquidity. So they're going to liquidate your position to take the buy. So in this case, we know this was where the demand was. So we're expecting price to bounce off it, but they've not swept liquidity. So we want to expect them to take liquidity because liquidity is actually going to be below this low. Because imagine everybody's taking trades from here. If they want to take out those orders, they have to hit your stop losses. And when they take out your stop loss, it generates liquidity for them to go above, right? So you want to make sure your stop loss is here and your entry is here, right? So this is just me incorporating liquidity concepts and all of that into what we are doing. And I'm going to now show you real life examples in the market. And it's going to be, where is that eraser tool? So I'm just going to delete this, this. Anyways, I'll do this later. So let me explain what happened here. This is Bitcoin, and this is the 30 minutes time frame. Price broke structure. Price broke this structure like this. It just like took out this low. Let me remove this. Took out this low like this, and then as you can see, it tapped liquidity here. If you look at this low, oh shit, this low, price took it out without touching this other low. Because why did price do that? The same example, the same scenario I was giving. There's a high here. My chart is so cluttered. There's a high here. What's this? It's cancel, please. There's a high here and there's a low here, right? And price went up from this low to create this high. But price failed to break above. Instead, what did price do? Because it didn't have enough momentum to go above. So it had to come up, come down before eventually breaking. Right? So when price comes down, we expect that price is supposed to what? Create a new low and then shoot up. But that cannot happen because price not tapped into liquidity. So the liquidity exists below this point. So for everybody who will be taking trades here, so people will be taking trades here, they're going to be putting their stop losses at this low. And all those stop losses are generating, like it's a huge liquidity pool that's forming. And they reinforced this again by allowing price break the structure. So price broke the structure now. And you say it broke it with this, but this is not actually a break of structure because you can see can't be not close above it, just a week. It just went up, tested it, and came down. But people would think it's a break of structure. So when price now comes down to this level again, especially when it clears this other week, they would think it's a intercept liquidity because see what price did. Price came down. Let me take this out. Came down, reacted off this level, immediately cleared liquidity. It reacted. So people think, oh yeah, that's the cue. You have to like start taking more buys, and they'll take more buys here. Let's say they take buys here because they saw this happen. Where are they going to put their stop losses? Below this low. More liquidity is being generated, right? But you will understand what had happened in the past here. you're going to wait for price to come down to take this liquidity. So instead of taking your trades here, you're actually going to wait and place your buy position at the bottom of this range, which is here. Okay, long position here. And then your stop loss can easily be below this point. And then you target the overall high, which is here. Okay. So everybody will be targeting this high. This person would have won this trade because he targeted this high. Would have won this trade. Okay. This person wouldn't have won the trade. Stop loss will be hit. They'll tap into this point and then go up, right? And then that's for this move. Okay. So this is you just basically understanding liquidity, combining it with candlesticks, and you can see the force that came into the market. See the force that came into the market. And when you're looking at this candle like this is the M30. But if you go down to lower time frames, you're going to see break of structure. Right. You're going to see break of structure. This is the 3 minutes time frame. Price clear this liquidity, clear this area, taps into liquidity before going up. This is the 3 minutes time frame. But if you go down to the 1 minute, I believe you see some form of structural shift. Okay. It's very choppy, but still makes sense. If you consider this point to be a high, you see price broke it with so much momentum and it's coming down for a pullback before it eventually goes up. All right. So in this live stream, we've talked about time frames and candlesticks, right? And understanding candlesticks as well as understanding the time frames is what is going to make you profitable. So what you want to do with regards to time frames is you always want to start at the higher time frame to get an overall context of what the market is doing, right? So once you come on any chart, let me just pick a random chart. I don't even know what this is. You go to the highest time frame possible. Let me start from the monthly to see the big picture. Oh, really? I took a trade here. That's nice. Let me pick a random chart I didn't take any trade on. This is XRP. Right. So when you go to the monthly, right, you can see it's bullish. It's a bullish structure. Price went from here up, came down, went here, it failed to break this high. So it created this, came down here to create this low before going up to this point. And let me see. Right. So this is the structure. And the market, it just took out this high. This is monthly. It's crazy. See how it took out the high. So it has created a new high and is now pulling back. Where is it going to pull down to? It's going to pull down to. There's a demand here. The candle before the momentum candle. What's this? There's a demand zone here. But price has to sweep liquidity. Okay. So just judging from this chart alone, expecting price to come down, before eventually going up, if it's going to go up. But our idea of liquidity tells us that price is going to come below, right? It's going to come below this level because that's where liquidity is. So you want to place your trades here instead of at the demand, then target the high. But whether or not this is going to play out now depends on what price does in the coming months. Okay, if price comes down like this, creates a low, goes up, fails to break above this high, then there's a chance price might come down, take out this low, and spare this overall low. But this is just contextual. You just have to, follow the market and see what the market is printing, and then go accordingly. All right. And this is the monthly chart. We've seen what the market is doing. We know it's bullish. We know we're in a phase where the market is pulling back. So we'll now go down to the lower time frame weekly to get more trade ideas. So when you zoom down, of course, it's a pullback. So you're going to be seeing bearish structure. And how do you know this bearish structure has started? The market breaks structure. Break structure. Okay. This is the weekly. So every candle you're seeing takes a whole week. So it has a lot of information within. So you see it breaks here. You're seeing a week here, but if you go down to like 1 hour, this whole weeks, all these weeks are candles, solid candles. So when we are treating higher time frames, the weeks are actually very, very important. So when price breaks structure, what do you expect? A pullback. A pullback into what? Supply. The candle before this momentum candle. Supply zone. Supply zone. Let me just highlight this. Supply. Right. So when it gets to supply, what does it do? It's going to come down to break another structure, to break the low that was formed. And it did that here. Broke this low. Whoosh. Broke this low. Right. So when it breaks the low, what you're expecting? Another pullback. Where is it going to pull back to? Another. Let me do this. See? Crazy. It's going to pull back to another what? Supply. Where is the supply? Because you're seeing that the candle didn't just break this. Now let's analyze this. I actually had a pending order here. I've not even checked it in a long time. And I'm just coming to see that it's played out. So you have this low, and you now have, from this low, price went on to create this high. Okay. Because you can see from this point, it went up, did this, went up, created a new high before eventually coming down. But price didn't just come down straight away. What price did was, price came down from here, created this without breaking this low, went up, created this high before eventually breaking. So where is our liquidity going to be? It's going to be above. Price has to take out this high. That's why I set this trade at the top of this high. And you see how tight my stop loss was. It was above this other high. And its price just reacted from it. Okay. But ideally, I'm not even supposed to be taking this risk. I'm supposed to even raise my stop loss to this high overall. But this is a much smaller risk. And I'm going to stick with this for now. If price breaks it, I'll take the trade again from the top. Okay, so this is what I'm talking about. So now we're expecting price to now start coming downward. First of all, we're expecting price to come down to take out this low. First, that's our first take profit. And then when it takes out that low, it's actually going to go into demand because there's a demand zone here. They're just tracking demand zones, demand and supply zones, go into demand. When it taps demand, because it has broken structure and because it has broken structure and it has gone into demand, you're going to expect what? And that pullback. And that's how I keep tracking the market movements. Remembering that you are in a pullback phase. Okay. So until the market has gotten to this bottom, you're going to be taking sales, bunch of sales until the market gets to this point. When it gets to this point, you now wait for it to sweep liquidity and then start looking for structure to shift bearish, to shift bullish before you start taking bulls, buy positions. So that's just it. That's just how you correlate time frames and candlesticks and market structure and all of the things we've been talking about. All right. So this is going to be the end of this video, and I am going to see y'all in our next evening session. I'm going to do a recap of this morning session in our evening session. All right. So just do well to share this to your friends, acquaintances, whoever you think is going to be interested. And I'll see you guys. Bye. Do have a nice day too.